Okay, yeah, what's good, YouTube? I'm back at it. I've been slacking these past couple of days, not making videos. It is what it is. My bad. That won't happen again. So I have like three or four, maybe five videos I gotta make, and they're all gonna be in these drippy ass Christmas pajamas. So get ready. If you see me in the same outfit, that is why. I am not a nasty dude, so I am changing my clothes. Anyways, we've been over candlesticks, what you need to begin trading. You have all the tools now. You have what you need to begin trading. You got the videos, you got the apps, you've got everything you need. It's time to get into some actual stuff, some actual concepts. You know what the candlesticks mean. You have everything you need to take to expand on what it takes to begin trading. So, the very first concept I want to cover is what is liquidity? Liquidity is what moves these markets. So liquidity. So let's draw out some stuff actually. So good old trusty brush. I'm gonna draw a uptrending market. So that's followed by move down, a move up, a move down, a move up, move down, move up, move down, and a move up, like that. That is irritating. Okay, whatever, man, whatever. Cool. So that here is a uptrending market. It's not gonna let me zoom out. Cool. No. No. Cool. Okay. Whatever. We're just gonna pretend this top piece up here that's covered in the rectangle is just not there because what the fuck? We have an uptrend. These markets contain these points here that contain liquidity. So liquidity by definition is resting stop losses, resting take profits. That's called liquidity. It's what moves the markets. Liquidity makes markets go up. Liquidity is what makes markets go down. It moves the markets. And the market only has two jobs, to fill orders and fill imbalances. That's the only two things the market will do. So the market, for instance, likes to go towards these places here at these tops and these bottoms because these have resting stop losses and resting take profits. So I'm gonna show you an example on the chart. So my chart is being so weird, and I just hate that. Whatever. We're on the Nasdaq E-mini futures here, MNQ, right? So we're gonna look here. This happens, and everything I'm gonna talk to you about happens day in and day out of the market. It's just how good can you spot them that is gonna make the difference in your trading. So these here, old highs, old lows. Well, all right. What what do these mean? Why is this important? Well, if I'm placing a long position, where's my take profit going to be if I'm trying to long from here? Well, this is my stop loss. These stops get hit by these wicks here, and they move the market up. So this is an example right here of how these wicks here, as I covered in the very first video, of how these wicks will play a big part. And they come in a lot more important later, but these can hit stop losses and these can cause the market to move up. If I'm going to take profit, I'm going to take profit at, well, a high because I want the most money out of my trade because who doesn't, right? These areas here are take profits. And it could be the same deal with someone shorting. So someone shorting could have their take profit from these highs, which are going to have stop losses as well. And they could have their take profit, I don't know, all the way from, they could have it here at these lows, here at these lows here, here at these lows. It could be at these lows, these lows. You get the point. These places, these highs and lows have stop losses, take profits, and actually they even have orders to be filled, which the market likes because that's the only two jobs of the market. Stop loss, I meant fill orders and fill imbalances. Okay. The market always moves where the liquidity is. The market goes where the liquidity is. So let's say we have, let's go in replay mode actually. Where's it at? Up here. And I'm gonna click literally a random date. So I don't know what's gonna happen. I'll click it like 4 times. There you go. Boom. All right. And this is a range day, so this is shitty. You don't want range days. The market has liquidity here, here, here. It's at highs and lows, right? And this is ranging, so well, this is actually a trending. This here is trending. This here is ranging, where you go sideways. Trending's actual up, down, or down, up. You get it. That's trending markets. So liquidity comes in two forms. There is external liquidity and there's internal liquidity. So external liquidity is going to be your old highs and your old lows. That's external liquidity. Internal liquidity is going to be your fair value gaps, your order blocks, your breaker blocks, anything like that. That's going to be your internal liquidity. And a lot of liquidity. So if I'm shorting, I'm going to target not only these lows here, right, as I talked about before, but we're going to target the fair value gaps. Now, I just make this one longer. This video is going to be a lot longer. So now that we know where, liquidity lies in these markets, we can go into the the bigger time frames, right? And we can figure out take profits here. So let's say I want to short from here, given confirmation. We have a bearish SMT, so it could happen. Never know. I could short to these lows here as take profit 1. Same here, take profit 2, 3, 4, 5. You probably wouldn't want to go like here. You probably just want to target one of these and then go here. Well, let's just look what happens. Let's see. Okay, this might go higher, might go lower. I don't know what's gonna happen. Let's just see. I'm gonna put it on 10 speed, so it just happens. I'm gonna up the time frame to like 5, so we get some actual moves here, or maybe 15. Or it might go here to this. I mean, I don't know what's gonna happen. So, well, there you go. It's wanting to go down. Nah, there's buyer pressure there. We're not watching that. That's fine. Anyways, point being, external liquidity, internal liquidity. Liquidity is your best friend. You should set your stop losses based off of liquidity. You shouldn't set it based off of, I don't know, some random level. Let's say I want to short this move right here. Well, why would I have my stop loss just all the way up here for a negative risk to reward when you could have it here above these strong highs here that haven't been taken out yet? That's a smarter stop loss versus something down here. And why would you, and it could be the same deal with a take profit. Why would you have it here when you could have it like down here where there's liquidity and maybe the market will go to it? But then again, you have to have confirmation for any trade you take. You have to have confirmation for anything you do. That's just trading. You can't just gamble and hope something happens. That's just what it is. Liquidity can get swept out a lot of times, and this is a really important part of the trading strategy. They are called liquidity sweeps. Liquidity sweeps happen on the chart everywhere, literally everywhere. Like this down here. I hate that my chart is doing this. This is a liquidity sweep because why? It's a long wick. It doesn't have to always be as long. It could be all the way down here or it could be here or like here even. The point of it is that these liquidity sweeps have to take out lows or old lows. So this liquidity sweep took out this low here, and this liquidity sweep almost took out this low. But when liquidity sweeps happen, they often move the market up, right? They often move it up. Now, granted, you have to get an entry off of it, so you can maybe enter off of this break of structure combined with a fair value gap. Liquidity sweep, break of structure, liquidity sweep, fair value gap, liquidity sweep, breaker block, liquidity sweep, order block. I'm going to teach you all that later, but again, I want to go to I'm going to go to Forex because Forex has cleaner price movement, the chart's more full like this. Let's see. Let's find another liquidity sweep. So liquidity sweeps can also happen from the downside. They can happen to the downside, so they can happen up here, or they can happen down here. Liquidity sweeps happen all across the chart, and they happen in real time. It's how good are you at spotting them, essentially. Um, I usually look for liquidity sweeps on the 15-minute time frame because higher time frames have more power. You can look for them on the daily time frame even. They happen day in and day out. See, this here is a perfect example of a liquidity sweep. Why? Big move up. We took out these old highs here. Okay? You took out those highs. You get a huge move down for like the next, let's see, October to literally like January. You see how good these liquidity sweeps can be if you catch them in real time? Let's see. Liquidity sweep here. We swept out these lows here. That's a perfect That's perfect. You were trending up from December 23rd until July 24th. If you catch these moves in time, like I'll show you, like you can make a lot of profit. But you have to have confirmation to go long. And I'll see there's just news and that's all news. You don't have to worry about that. I'll just buy 30K units, which is like maybe 1,000. I don't know how much money it is. It's enough money, point being. Can I speed this up? That's as fast as that's gonna go. Point is, you're up a lot of money. Anyways, liquidity sweeps. Remember, liquidity can sweep out old highs and old lows. If it sweeps out old highs, it's going to move the market down. If liquidity sweeps sweep out old lows, like they do here, they're going to move the market up. Now, I'm going to teach you about that is liquidity sweeps. So we've learned liquidity sweeps. We've learned liquidity. Okay. We've learned external liquidity. We know what internal liquidity is, and I'm going to get into. I'll just make it a longer video. It's cool. This video can take forever. I'm fine with that. Okay. Now, the first form of internal liquidity I want to talk about are fair value gaps. So, fair value gaps are imbalances in a market. So, let me draw. We can have a market go like this. This here is an efficient market because the market comes down and it tests all of these levels. It's called an uptrend. We're making higher highs, higher lows. See? More up, more up, more up, more up, more up, more up. All right. You can easily tell what an uptrend is. Now, this is an efficient market because we're moving in an efficient manner. This is an inefficient market. You're going up, you make your move, right? That's inefficient. And it causes inefficiencies all throughout the market. Now, remember what I said earlier. The market's only two jobs are to fill imbalances and fill inefficiencies. These inefficiencies really they act as a magnet to price. So price the market's job is to fill inefficiencies and imbalances. These are called inefficiencies or imbalances or fair value gaps. These fair value gaps are gold if you can use them right. And I could show you probably a great example of it actually. So like I said, I'm gonna go to a random day. Random day. Oh, I should probably explain how fair value gaps work. So let's go like this. Let's draw a candlestick. Boom, boom, boom. So fair value gaps happen in a three candlestick succession. And they happen like this. Let's go. Shit, that's the wrong one. Uh, 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 uh. Let's just pretend that wick is straight. Oh my goodness. I don't know. Oh my god, brother. I'm sure you see why I keep clicking that one because it just looks exactly how, think it would. Cool. So, fair value gaps. They happen in a three candlestick succession. Always, they always have, they always will, no matter what. These are everywhere throughout this chart. It's how good you are at finding them. So, these fair value gaps, they happen when these wicks here do not close below the body of this candle. And that leaves an inefficiency or an imbalance in price, and it will cause price to often retrace back to it, leaving a fair value gap. And it'll look something like that. So let's just type in a fair value gap. And people often abbreviate that as FVG, and you will know that if you read the vocab section in the Discord in one of the channels. Great, great. Fair value gaps. They act as a magnet for price. And these can be used as entries because they often retrace back to these fair value gaps. Now, fair value gaps. I told you they are gold and they are great. They are, and I'm going to show you why. Fair value gaps often get left. Okay, so let me explain to you why fair value gaps are important. Fair value gaps have a 50% encroachment. If they hit, so let's say I'm going to use my brush because it's just easiest to draw. Let's say price is uptrending and there's a fair value gap. Remember how I talked about fair value gaps act as magnets in the market? If there's a fair value gap or inefficiency or imbalance nears the top of something, like a top of a range, like up here or something, and we want to target that because, well, it's in the higher time frame, so the price must want to attract there because fair value gaps act as a magnet to price. So you can use these in the higher time frames, like the daily, 5 hour, 4 hour, 1 hour. It's really not going to let me go. This is okay. This is 1991. God damn. Okay, we're gonna exit that and fucking go to something closer to today because 1991 is way too fucking far. Random bar a couple times. Boom. Cool. All right. We're gonna go to the daily. Okay. Like I said, fair value gaps, they have a 50% encroachment. The fair value gap oftentimes comes up and it gets tagged like this, and it might reject. And that gives you an entry here to go short. Now, again, you have to have confirmation, and I'm going to give you the full strategy. You just have to understand what you're doing, or none of this will make sense. Fair value gaps like to get filled. So ideally, you see it come up, and you see it reach the 50% mark. And then they can either fill and you go up off of it, like that, or you can reject and go lower, something kind of like this. And then on the way, you're going to cause more inefficiencies, just like this. And that's why price always moves up and down. And that's what makes price move the way it does. And I want to show you an example of this. I'm going to turn on the indicator for fair value gaps. And I just want you to watch. These greens here are fair value gaps. See how this here has been mitigated because it hit the 50% encroachment mark. See, by this candle, and we're probably going to see more of that. So, okay, I bet this fair value gap up here gets filled because that's what market likes to do. It likes to chase towards these fair value gaps. And along the way, it leaves fair value gaps. It leaves inefficiencies. You can target these. Now, granted, these fair value gaps don't always get filled, but they usually do, and they like to get filled. There's a super big imbalance here. Since this is a lower time frame, it might not get filled, but just know the price does like to attract back to these points. So Again, I'm gonna go up to the higher time frame because I want to show you that these time frames, I mean these fair value gaps in the higher time frames, they like to get filled. They love to get filled. They just and notice how you don't see them back here in time. It's not because they don't pop up. It's because they got filled. These things like to fill. And I want to show you one of them. Maybe this one gets filled first because, it's the closest. But, I mean, we'll have to see how the price moves and how it works and stuff. Okay, cool. Look, this is the daily imbalance here. We're trending up. See how this is getting used as people's entry here? Okay, great. You taking out these daily imbalances. And this is a huge part of my strategy, and I'm going to explain it, but you just have to be here to understand how these fair value gaps work for you to, make any sort of trade or entry off of it. People are using these fair value gaps as entries and exits. I mean, it's just, and these happen every time frame, every day, every minute or so. It's just a matter of how good you can catch them. Same here with the 12 hour. I bet this retraces back to this 12 hour, or maybe it just keeps going up. See, this one filled. It's just liquidity sweep. Got a liquidity sweep here. Oh, okay, doesn't matter. Liquidity sweep. Okay, well, this is just going to keep trending up, I bet. But you know what? It's the point. These fair value gaps exist. They like to get filled. Market's trying to do its job by not only filling orders, but also trying to fill imbalances. So that is fair value gap. So we covered candlesticks, fair value gaps slash inefficiencies, imbalances. We also covered liquidity sweep. So liquidities. Yeah, okay. And the last thing I want to talk about to you for just just for today, is equilibrium. So equilibrium is a point in the market where price likes to either so okay, I can show you better than I can explain it. So you draw equilibrium with the GAN box, and these are the settings for it. You find the GAN box over here, and then it's going to be GAN box. The settings for it are 0, 0.5, 1, left labels, right labels, 0, 1. Then I just turn the background off. You can have it however you want. Cool, cool. You draw it from lows to highs. And this level here is going to be a retracement. And you can base an entry off this. If price wants to bounce off of equilibrium, well, there you go. It bounced. Price might reject off equilibrium, like it kind of did here. But you don't want to have your entry just based off of equilibrium, because what equilibrium really does tell you is that if price is at a premium, so premium is something, another vocab word in the trading Discord. Premium's an expensive price that's not really attractive to buyers. And we don't want to buy we don't want to buy something that's uh super high in price. We like to buy at discounts, just like you like to buy at discounts. Why would it be any different for the markets? So instead we sell at premiums. Generally speaking, we want price to be around this equilibrium range when we sell. I meant when we're trying to take profit. So combining this along with, let's just do this. Let's just sell. Show you that price, it wants to fill these imbalances, and it wants to be towards equilibrium. It might not always get to equilibrium. It might not, and that's okay. But the point being is that you want to buy at a discount down here and you want to sell at a premium, because you that's how the market likes to work. You don't want to buy something at a high price. You want to buy low, sell high, and buy low. And that's what equilibrium allows you to do. It allows you to do just exactly that, what you want to do. And this is a good example of these imbalances trying to get filled. It wants to reach this 50% encroachment mark, but buyers come up. They make a new imbalance. I'm just showing you how these markets really like to work, how they move, why they move, what makes them move. That's liquidity. Liquidity moves markets. The banks move markets. Retailers like me and you, we don't move markets. It's only the big banks, only the big institutions. That's the only thing that's going to move markets. It's not us. So when the banks are buying, I'm buying. When they're buying at a discount, I'm buying. When the when the when they're selling, I'm selling. We can't move the markets. It's them, but the things we can do to be on the right side of it are get a good entry and have a good strategy, and I'm going to show you why. So I'm trying to show you in this video more so why things happen the way they do versus trying to actually get an entry because I feel like that's more important to actually know why something is doing something instead of just, hey, this is how you do this and this is, you know, fuck off, after that. I'm trying to show you why it works, how it works, and what it means because that's the most important thing. But this is equilibrium. You're buying at a premium and you're trying to sell at a discount. That's what that is. So in the video, we covered liquidity sweeps, equilibrium, fair value gaps. We've covered three of probably the biggest fucking things to the strategy I'm going to show you a bit later. Another thing I want to show you is order blocks. So order blocks are places where a lot of orders have gotten filled. And they can act as, I'm not a support and resistance trader because I think there's just better concepts than that. But basically what support and resistance is, it acts as a floor where price likes to buy. I mean, price likes to bounce off of. So this here, this could be support, and well, price rejected off of here, so this could be resistance. It's a very simple strategy. If price comes back down to here and it bounces, you buy. If price rejects off of here, you sell. That's what support and resistance is. That's all it is. There's nothing more to it. That's it. Now, what order blocks allow you to do, they allow you to do more of the same stuff as support and resistance. But order blocks can be entries as well. I mean, order blocks are basically supports and resistances. But order blocks don't go off of, hey, this is a magic ceiling and I want to break through this magic ceiling. I mean, it kind of is, but they're kind of not. If you like to use order blocks, go ahead. If you want to stick purely to price action, go ahead. I'm going to use order blocks simply for the fact that they are a smart money concept, and I am a smart money concepts trader because I believe there are better things than just, hey, there's a floor. I hope it bounces. This is basically what order blocks could be if you wanted them to be, but this is support and resistance in short. Order blocks are zones where a lot of orders are getting filled, and not in a sense like this where it's trending. They have to be in kind of a range like this where it's a bunch of orders packed together, and these orders, given confirmation, of course, can give you a lot of reason to buy and or sell. Well, that's a really big fucking thing. So up here, this could be an order block because these orders are filling and they're mostly sell orders and they're pushing the market down. You get a sweep of liquidity up here of these highs and you get a huge push down. Same thing down here. I'm gonna remove the drawing. You get a sweep of liquidity to the downside, taking out these lows here. Yes, it didn't move up immediately, but what happens is you wait for your entry. So I'm gonna go in replay mode. No, I'm not gonna show that. I'm not gonna show that just yet. Liquidity sweeps, liquidity sweep, sweep. Now, you might get a sweep, and it might not always go up immediately, but that's why you don't just enter off of a sweep or something like that. You need a breakup structure. You need a change. Maybe you need a market structure shift. So you need a. I'm gonna explain all that later. You just need to know why this is happening right now. I'm gonna explain probably the strategy in the next video. Then the next one could probably be risk management. I have mid-ass risk management, so it's gonna be everything I'm saying is gonna be very rich coming from me. So I'll leave that at that. And I'm probably gonna do a check-in video, and you guys gotta let me know where you're at with all this stuff so I can really just hone in on that specific thing and help you guys because, well, I mean, that's what I'm here for. I'm here to help you, so I'm not against it at all. But I think that pretty much covers everything oh no, break a structure. So break a structures are exactly what they sound like. They are structure breaking, and they can happen to the upside or they can happen to the downside. So let's take here for example. They happen all over the chart. It's simply, can you spot them and how well can you spot them? Breakage structures are points where the price is likely to come back, and so it's basically points where the market's like structure and integrity is likely to shift. So a break structure, for example, could be here, and it's very simple. One of the simplest things you'll learn. So that's all it is. It's literally structure shifting. That's it. Now I'm going to show you a downside move. That's all it is. Literally all it is. It's a wick or a candle that is in the past, not super far back, like fucking back here. Don't be an idiot. It has to be a candle within the range of like three, four, five, maybe six at the most candles. And you're gonna take it. If it if these candles over here break up towards this, that's a candle. That's a break of structure. Another example. This candle here, it has to close above this wick for it to be considered a break of structure. It's that simple. Your break of structures are going to happen a lot on the lower time frame. It's up to you to filter them out. And I'm going to show you an example of the entry strategy here. Right? We know this is going to move up because this swept out lows. It swept out a really huge fucking low. There's no lows in sight until you get, well, all the way back here. Cool, cool. There's probably an imbalance back here that got filled. There's one up here. Point being, I'm going replay mode. Okay, look here. We have a bunch of imbalances up here we want to fill. Those will probably be my targets. Sellers pushed up. You swept out these lows. Now, like I said, when you see a liquidity sweep, you don't want to immediately enter. You want to enter off of a liquidity sweep, a break of structure. So the combos are going to be liquidity sweep, break of structure, liquidity sweep, order block, liquidity sweep. I mean, if you want to use support, liquidity sweeps, fair value gaps, break of structure. So my ideal entry is liquidity sweep. Oh, okay, we got the sweep, but we're waiting on a break of structure here. Oh, would you look here? Would you look at it here? We got a liquidity sweep, break of structure to the upside, and a fair value gap. That's an entry. Now, granted, that fair value gap doesn't get disrespected. Well, it filled its imbalance, which was its job. Huh, this one, another fair value gap. That's an entry to go long. And then you could just ride price out until you get a clear reversal signal. Maybe your exit is these top of the range right here or something like that. The point is, liquidity sweeps, these break structures, these uh, fair value gaps, they all happen in real time. It's simply how good can you get at spotting them? Simply. I sound like a broken record saying this, but this is as true as it can be. So I want to show you that. Um, so that's basically everything you need to know for the entry. I will go through each individual like part of this video, but I'm just introducing the concept now, and I'm probably gonna go back, make I'm not gonna go back and make a video on liquidity sweeps and liquidity because I feel like I explained that well enough in this video, but I probably will go back on the fair value gaps, the breaker blocks, stuff like that to explain more on those. But I'm just introducing the concept today. That way it all actually makes sense for you. Well, not make sense, but so it could be introduced to you, and that, oh, when I'm saying these things, you got a general idea of, hey, okay, this guy is talking about this, or he's talking about this. But that's why I'm showing this all for you today, so you can just get the get an idea. I actually probably will just probably spill the beans on the trading strategy because I want you guys to actually use it, practice it, and get good with it. And I don't want to gatekeep it till like, I don't know, day fucking like 100 or something. And then I'm just like, hey, okay, well, this is what you finally do. But I do want to introduce these things, build on those things, these concepts, and I'll show you, you know, what this stuff is. But, anyways, that's it for this video. I will be right the fuck back with another video in about 5 minutes. So, I will see you guys very, very shortly. And I also got trade recaps coming up. I also got more of these videos coming up. So just stay tuned, stay with me. I'm on the grind right now. I'll be back. I see you guys.